Hello, Jason Bates here, owner of Electrum Financial, a mortgage broker located right here in beautiful Cave Creek, Arizona, where a mortgage is not a flip of the coin. So if you're looking to purchase or need to refinance, I would like to be your broker of choice as I have access to the lowest rates at the lowest cost in Arizona. And if you don't believe me, call me. Here is this week's mortgage market at a glance. This week's 6.4% reading on the Q1 GDP reinforced the notion of a strong economic recovery. In turn, the recovery helps to justify the sharp move higher in rates seen during the same 3 months. Rates managed to recover quite a bit in April, but ended up rising slightly this week. The following charts offer several ways to look at the intermission, which is basically April's pushback against the previous 3 months of significantly higher rates. Mortgage rates have outperformed other parts of the bond market, even though they remain highly stratified by loan type and investor. As such, the intermission looks healthy at first glance. The 10-year Treasury yield, which is the quintessential benchmark of broad, longer-term rate momentum, does a better job of showing this week's modest upward drift after bouncing several times at 1.53%. Now, if I zoom out, you can see that April's consolidation/correction takes place exactly where I'd hoped based on previous videos of the hitch zone. In general, this means that rates have risen enough to justify taking a slight break. The hitch also serves as a reminder about how much more ground rates could cover or recover if things go very well or poorly for COVID and the economy. Indeed, that's what this is all about. A fact that was reiterated yet again in this week's press conference following the Federal Reserve's policy announcement. The Fed announcement days have a track record as being some of the best or worst days for mortgage rates. That said, they can be completely meaningless as well. And that's the designation I'd pick for this week's version if I had to pick one. Yes, but it's important to understand that refers to the Fed's funds rate, a target rate for overnight lending between big banks. Mortgage rates can loosely correlate with the Fed funds rate over a long time horizons, but they frequently move in the opposite direction. More importantly, mortgage rates are consistently moving, whereas the Fed funds rate hasn't changed in more than a year and is usually only capable of changing once every 6 weeks. Outside of extraordinary circumstances, of course. Simply put, the Fed does other stuff besides announcing the Fed funds rate. That's just the piece of the announcement that news outlets tend to lead with. Mortgage rates are far more interested in the Fed's bond buying programs, which include $40 billion per month in new mortgage bond purchases, and in addition to reinvestments of proceeds from past mortgage bond purchases. On that topic, the Fed held steady and indicated we're still a long way from a situation where bond purchases would be tapered. Some market participants have wondered why the Fed continues to buy the same amount of mortgage-backed bonds in light of blistering pace of home price appreciation. Case in point, Tuesday brought another month's worth of home price data from Case-Shiller and the FHFA. When questioned about the ongoing mortgage bond buying, Fed Chair Powell reminded us that the mortgage market is one of 2 key sectors the Fed can target in the pursuit of its goals. In other words, the Fed decided it needed to spend a certain amount of money buying bonds, and the mortgage market is one of the 2 key places it can spend that money. Despite being fairly familiar with this narrative, the mortgage market was nonetheless marginally relieved to get additional confirmation. A key reason that the mortgage rates did better than Treasuries in the second half of the week. Now, while the Fed offers unequivocal support in the present, traders continue to worry about the future. It's easy to imagine a scenario where the economy has healed enough for the Fed to start dialing back. When that happens, it could be the catalyst for rates to officially break out of the intermission trend and resume their upward march. In this week's other housing-related data, pending home sales, which is the timeliest of the home sales reports, avoided losing any ground after a 4-month slide. Realtors rightfully point out the lack of inventory as the biggest detractor to what would otherwise be record numbers. This week brings a slew of big-ticket economic data that could further push the recovery narrative, including the big monthly jobs report on Friday. If the new numbers are as strong as they were last time, it would bring the Fed one step closer to actually having that discussion about tapering. Rates probably wouldn't love that either, so stay tuned. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you, and that's for sure. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I would like to be your broker of choice. So until next time, take care and stay safe.